Good evening, everyone. Thank you for joining us today. I am Rani Srivastava from Trust Mutual Fund. Today we have with us Mr. Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Mihir has over 3 decades of experience. He has managed over 1.3 lakh crore AUM and held senior roles at Max Life Insurance, Abu Dhabi Investment Authority, HSBC, ICICI Prudential, and SBI Mutual Fund. Mihir has proven track record across various asset classes, including equity, fixed income, real estate, and alternative investments. Please join me in welcoming Mr. Mihir Vora. Before we begin, I request all participants to kindly post your questions in chat box. We will address them towards the end of the session. Over to you, Mihir sir.
Thank you. Thank you, and good afternoon, everybody. Thanks for joining here, and it's my pleasure to speak with you. Uh, Most of you, I'm sure, are familiar with Trust Mutual Fund, but for some of you who may not be very aware or joining us for the first time, just spend a couple of minutes on introducing the Trust Group and the Trust Mutual Fund to you. Rani, is my screen visible?
Yes, sir, it's visible.
So Trust Mutual Fund is one of the newest mutual funds in the country. While we got the license about 5 years ago, we launched the fixed income funds. After that, when we introduced the equity funds about 2 years ago, our first equity fund was launched in April 2024. And today we are at about 4,000 crores in assets, including 2,800 crores in equity schemes. So totally we have 11 schemes, out of which 3 are equity, and we are launching the fourth one, which is the mid cap fund. So far, we have the first scheme, which is called the flexi cap fund, the second fund, which was the small cap fund, the third fund, which was launched about 7 months ago, which is the multi cap fund, and the fourth one we are launching now is the mid cap fund. So idea is to basically launch the basic products first and make sure that we are out there in the market with products that the distributors can sell. So we are in the process of offering the entire bouquet of products for our investors and our distributors. We've already crossed 100 people in the team size. We have 21 locations across India, covering the key states and markets. We have 15,000 plus mutual fund distribution partners who are selling our products, and we have crossed an investor base of almost 1 lakh folios with 92,000 unique folios. So it's a good achievement for a for a young fund house, and we want to do this the right way with the right people, products, process, philosophy, performance. We are in no hurry, so it's not like we're going to spend a lot of cash and burn cash and open branches in branding, etc. We believe that we have a differentiated approach that investors will appreciate. And as long as we have that differentiation in the products and the performance, money will come in. We will be one of the successful AMCs. So idea is to go about it in a very rational way, in a very sane way. The strength of the group comes from the promoters. We have very eminent promoters, very old hands in the Indian capital markets, highly qualified professionals, Utpal Seth and Nipa Seth. Nipa started Trust Capital, which is where the name Trust comes from, 25 years ago. And today, Trust Capital is the largest non-bank debt broker in the country. And it has got a total employee strength of 250 people all over India, mostly in Bombay, of course, doing the origination, sourcing, underwriting, relationship managers for bonds. It's a B2B business, but very large B2B business with all institutions and corporates are the clients. Utpal Seth needs no introduction. He's amongst the gurus of Indian stock market. He started his childhood in a broking family. So at a very young age, he was writing research reports, reading annual reports. He's a chartered cost accountant and a chartered financial analyst. So again, very highly qualified. For the last 25 years, he was partners with Mr. Rakesh Junjunwala in the Rare Enterprises family office. He was the CEO. So, it's very well known in terms of equity investing, especially fundamental based long term equity investing. So that's the promoter group. I guess it places us amongst very few AMCs which have a lineage where the promoters themselves are such high profile, investors themselves with a long, visibility in the market. So that gives us that edge in terms of the approach to the business. Trust Mutual Fund is run very professionally. Sandeep, who's the Chief Business Officer, all of us are from the mutual fund industry with extensive 20 to 30 years of experience. So that's where we stand. So, of course, we are gathered here to understand about the new fund launch. But as I said, some of you might be, new to the system. So before I talk about mid cap fund, which is the equity fund, I think it's relevant and important that we also talk about our investment philosophy. So I'll just spend 5 minutes on our investment philosophy. Uh, So Trust Group, as I said, we have a long lineage of investing in stocks. Utpal in his role as CEO of Rare Enterprises, I in my role as head of equities, fund manager, and CIO at various places. Uh, but the common thing between us is that ultimately we believe that profits drive stock prices. So the the investor's aim when he comes into the stock market is to basically get capital appreciation. The stock prices should go up of the companies that they are investing in. But what exactly drives stock prices? I think that's the key question. What ultimately is the reason why stock prices go up and down? Uh, so we've seen, and it's a universal fact that ultimately it is profit that drives stock prices. So as long as the profits are growing in the long term, the stock price will replicate that profit growth. So if a company in 20 years grows profits at 20% compounded, then it's very likely that the stock price would also give those kind of returns. So growth investing is all we are about. We believe that India is a growth market. India is a fast growing economy. Within that, there are many stocks and sectors which are growing even faster. So investing in them will create a lot of long-term wealth for all investors. So we are all about growth investings. But of course, as we know, stocks don't remain attractive at all prices. There are valuations to be understood and taken care of. So we want to buy growth at reasonable valuations. We call it GARV approach. Uh, but to be frank, even GARV or sometimes also some people use the word GARP, growth at reasonable price. That's again not a very unique philosophy because a lot of fund houses also talk about growth investing, they talk about corporate profit growth, etc. What differentiates us is the fact that we use a very differentiated framework for arriving at valuations. So when we say that we want to buy stocks at reasonable valuations, how do you arrive at those valuations? How do you determine what the valuation of a stock should be? And that's where our secret sauce lies. That's where our differentiated insights lie. That's where our wisdom lies. The whole concept of our approach to valuations is called terminal value investing. Terminal value investing. Let me explain terminal value investing in short. As I just mentioned, India is a growth market. Within that, there are always new stocks and sectors or existing stocks and sectors also which grow. But these growth rates are higher than the market, higher than the economy. And more importantly, many stocks and segments keep on growing for a long period of time. It's not like a 1, 2, 3, 4 year story. We have seen instances where companies maintain and sustain growth rates for 10 years, 15 years, 20 years, and good growth rates, 15% compounded, 20% compounded, 25% compounded growth in profits for a long period of time, right? Typically, we've seen that if you look at the Nifty for the last 20 years, the growth in Nifty profits has been about 12%. 11 to 13% is the growth in Nifty profits, and that's the long-term return that the Nifty index has given us, right? But within that, as I said, there are always new stocks emerging, which potentially can grow for very long at very high rates. The valuations of these companies is what differentiates us. So, for high growth stocks and sectors, where the length of the runway of growth is very long, which means that the company can sustain that growth for very long, the valuations of those stocks are not really determined by the next 1 or 2 years or 3 years of profit growth. The valuations of these stocks are determined by how long we think the growth path is going to last. Now, let me explain to you in a more simple term. You know, one of the biggest successes that that we've seen in the market is Mr. Junjunwala investing in a large jewelry company, the leading jewelry company. This was about 20 years ago. At that time, the market cap of that company was around, let's say, 4,000 crores, and the profits were around 80 crores. So even at that time, that company was trading at a PE ratio of 50, 4,000 by 80. Now, by any comparison or yardstick, 50 PE is a high PE because the markets trade at 15 to 25 PE. In fact, 20 years ago, the markets were trading even cheaper, 12 to 15 PE. So it apparently was an expensive stock by normal standard, if you just look at the PE. Now let's break it up and see what the market is telling us. The market is telling us that today the profits are 80 crores. It's growing very well, let's say 25%. So tomorrow, next year, the profits will become 100 crores. After that, it will be 125 crores, 150 crores, and so on and so forth, 200 crores and stuff. But if you look at the total of the profits for the next 5-7 years, it's going to be 600-700 crores total. So the next 5 years of profits probably only explain 600-700 crores of market cap. The total market cap is 4,000 crores. So 3,300 crores is what cannot be explained by the near-term profits. This is the value that the market is giving to future profits, the longer-term profits, the profits beyond the first 4-5 years. And this is what is called terminal value. So 3,300 crores is probably the terminal value of this stock. Now our job is to figure out how this terminal value, is it too low or too high? The market is saying that almost 80% of today's market cap, today means at that time, is explained by the longer term profit growth, not the near term profit growth. So in such stocks where the market is expecting growth path to be very long, for very high growth for very long, it becomes important to figure out the terminal value. And that is what determines our differentiated approach to valuation. So we look at a stock, try to figure out how long the growth path will be, how high the growth rate can be for the next 10-20 years, and then arrive at a valuation based on terminal value. So we are looking at stocks which have a high terminal value, which means which are stocks which can sustain growth at a high pace for a long period of time. And that basically means that we have to take a very long-term strategic view on the stock while arriving at valuations. We call them gorilla stocks because such stocks are not easy to find. Gorillas are rare monkeys. They are not very easily available. You can't really find them, near the cities. You have to go deep in the jungle. So these are rare stocks. But because these stocks grow for so long, they become large and dominant in their respective fields. And most importantly, the life of the gorillas is the longest amongst all the monkeys in the jungle. We are looking at stocks which have a long life of growth. So we are looking at stocks which are rare, which become large and dominant, and stocks which have a long life of growth like a gorilla's life. So we call it gorilla investing. This applies really very well for high growth stocks and sectors with a long runway of growth. And this is what differentiates our investment philosophy versus the rest of the world. So, to put things in perspective, there are fund houses where growth matters, but here we are talking about next 2, 3, 4 years of growth, which is what typically projections are available for. Then there are fund houses which are very value biased. They look at low PE, high dividend yield, etc. There are fund houses which are quite momentum based in terms of price momentum. We stand here where we pay equal importance to growth and equal importance to valuation. But the way we look at valuations is the prism of terminal value. So that's how I wanted to spend a 5-7 minutes on our investment philosophy. Now let's come to the mid-cap fund launch. As I said, we have 3 funds already. We are launching the 4th fund. Why mid-cap? Okay. So there are 5,000 stocks in the market. My guess is about 1,100 stocks with a market cap of more than 2,000 crores, out of which there are 100 large caps, which is the definition of large caps. The next 150 stocks are mid caps, and the next 850 stocks, by that logic, should be the small cap stocks. So, small cap stocks, there is a lot of small cap stocks to choose from. They're very exciting businesses. A lot of them are fast growing, but you have to be very selective because the choice is very wide. Second is because they are small in size, the risks associated with smaller businesses are there in the small cap space. So bank funding is difficult to get, equity funding is difficult to get, suppliers may not give you credit. So there are risks associated with being small. But of course, if you get the small early enough, then these are the ones which will ultimately become multi-baggers for you. So exciting space with a little higher risk because of the fact that you are small. Your business model also may not have fully evolved. But once the small cap starts tasting success and it becomes, stable, then you can say that the business model risk is gone. So now no longer there is proof of concept required. You have grown to a certain size. You have established yourself in the industry, in the market. So funds constraint reduces. So banks are more willing to lend to more known companies. Same for suppliers, same for customers also. So you become a more reliable, lesser risk company than a small cap. So mid cap stocks are basically small caps which have succeeded. The business model has been proven, risks have been reduced, and now you are in that high growth phase. You only have to focus on high growth because constraints of capital are no longer there. But you can focus on high growth for a long period of time. That's more important. You know, you are still not too large like a large cap that you can face constraints of growth. Your growth is only constrained by your ability to grow, which is internal. So mid caps are in that sweet spot where they are small enough to grow for a long period of time. They still have a long runway of growth in front of them, but they are not so big that you start hitting a growth wall. So it's that sweet spot of these 150 stocks. So wealth creation stage is what we call it, because since you are going to grow at a long for a long period of time, that's when the maximum stock price wealth creation happens. As of now, the smallest mid cap is approximately 35,000 crores in size. The largest mid cap is approximately 1 lakh 4,000 crores, 1 lakh 5,000 crores in size. So it's very big. It become very big. The the smallest mid cap actually used to be 8,500 crores 7 years ago. Now it's 35,000 crores. The market itself has grown so much. The largest mid cap today, which is 1 lakh 5,000 crores, used to be 30,000 crores. So in fact, the largest mid cap at that time is now closer to the smallest mid cap today. That's how much the market has grown. The mid cap index is fairly well diversified. As you can see, the top sector is 27% financial services, but the large cap index has much more of that, more concentrated. The second is consumer discretionary, which is only less than 20%, and rest all sectors are less than 15%. So the mid cap index is fairly well diversified, and it has a lot more exposure to domestic sectors, which is anyway our favorite, because we believe that the domestic economy will grow faster than the rest of the world. So we are happy to have such a diversified index. More importantly, the mid cap and small cap space has become too big to ignore. So out in the total market cap of the top 500 companies in India, 20 years ago, the top 100 used to be 83% of the total market cap. So it was very concentrated. Today, the top 100 stocks are only 60% of the market cap, far less concentrated than before. Because mid caps and small caps have grown faster and the relative market cap has increased. So almost 20% of the total market cap is mid and another 20 is small. So, they've become too big to ignore. Earlier, you could say that I will only invest in large caps, so I'm only missing out 20% of the market. But today, if you miss out on mid and small caps, it means you are missing out on 40% of the market, which is anyway the higher growth segment of the market. So that's how the relative importance of mid and small caps has increased. This segment has become too large to ignore. And more importantly, as I was saying, mid cap companies are established companies. They have come up from the small cap space because they are doing well and they have established themselves. So let's look at some of the leaders in some segments and they are actually mid caps. So GMR Airports, for example, India's largest private airport operator, which owns and runs the Delhi Airport, Hyderabad, Bangalore, and a few more, few others, is a mid cap. Naukri.com, owned by InfoEdge. InfoEdge is a mid cap. Indus Towers, largest independent telecom tower player, Indus Towers is a mid cap. Mobile phone manufacturer is Dixon. Fastest growing retail e-commerce is Meesho. Then you have Policy Bazaar, you have Paytm, you have Lenskart, you have United Spirits and Radico Khaitan, you have ICICI Lombard and GIC, you have Grow, you have Phoenix Mills, you have IRCTC, you have 361, CRISIL, MCX, Bharat Dynamics, Nykaa, BSC, Swiggy, Lotus Labs, Physics Wala. So there are many more examples I can give. But the point is that these are all large, well-known, established brands. These are not none of them would be unknown to most of us. So mid caps are a space where there is growth, but as I said, they are established business models, and they are actually, some of them are leaders in their respective fields. So that's the beauty of mid cap investing. We also see that there is a disproportionate representation of mid cap stocks in the growth universe. So if you look at the large and mid stocks, which is about 250 stocks, and you break them up into high growth segments and normal growth segments, within the high growth segments, almost 90 out of 120 are mid caps. How many mid caps have generated returns of 5x in 5 years? 17. 17 mid caps are up more than 5x in the last 5 years. Against that, only one large cap became 5x. 20 mid caps gave us returns of 3 to 5x, whereas only 4 large caps could give those kind of returns. And this is all function of growth, profit growth. If you look at the indices in the medium to long term, 3-year, 5-year, 10-year, 15-year, the mid cap index has done best. If you look at the compounding for the last 20 years, 10,000 rupees invested in the mid cap index is now 2.8 lakhs. Small cap is 2.1 lakhs and large cap is 1.7 lakhs. So that's the power of compounding. Why mid cap now? 2 or 3 things. Let me just give a bit of a market view also before I talk about it. My view as we stand in 2016, my view is that we have seen the worst of whatever could have happened last year. So, Operation Sindoor, Trump tariffs, currency depreciation, FII selling, AI hype where India was not there. Everything that could go wrong went wrong. Not go wrong, but it was all stacked up against us. What we did in the meantime is amazing. We cut income tax. We improved the income tax slab, so effectively cutting the income tax. Then there were the most aggressive GST cuts. The RBI cut interest rates, provided liquidity, stabilized the currency by selling dollars. All those factors, in spite of all these global and local headwinds, contributed to stabilizing the economy. And in spite of all these things, we managed to grow at 7-8% GDP. Valuations, I will show you in the next slide, have come to more reasonable levels. And you can see some green shoots, and consumption is going very well. We also signed trade deals with most of the major countries in the world. And finally, when everybody signed with us, even the US came around. So we have deals with New Zealand, Australia, UK, Europe, UAE. Canada is almost done. And after that, of course, the US also came through. So I think we are in a much better position than we were 3 to 6 months ago. FIs were selling because of AI hype. There were a lot of developments in AI all of last year, and India didn't have any companies in that space. So some of the FI selling was because they took money out from India, which had done very well for them earlier, and put money into US tech, Japan, China, Korea, Taiwan, where the hardware ecosystem is there. And China, of course, has its own AI company. So I think India was on the sidelines last year. But now I think the valuations of AI stocks have gone up so much, and there are so many moving parts now, as you can see daily, that probably things should start stabilizing, and that the over dependence or over reliance on AI should start reducing. We are already seeing some questions on valuation coming through. The good thing is that even before all this, we were growing at 7-8%, and even after the Trump tariff, etc., we are still growing at 7-8%. So our inherent resilience is clearly showing, and that should give a lot of comfort to FIs who were selling last year. In the last few days, we can already see that the rate of selling has come down. So hopefully this should, sustain. And once that happens, earnings growth is still, good. So as you can see in this chart, consensus expected earnings growth for the large caps is about 12%. For the mid and small caps is about 20% for the next couple of years. Valuations, I was saying, have come down. So from a peak forward PE of 36, mid cap PE is at closer to 27, small cap is at 24, and the large cap is at about 19.7, so 20. But thing to be noted, 27 looks expensive compared to 20, but this 20 is coming with 12% expected growth. 27 has a 20% expected growth. So the growth expectations are much higher, and that's what justifies the premium. Why trust mid cap fund? Because there are 150 mid caps to choose from. Minimum 65% of the corpus has to be in mid caps. We believe that some of the small caps can also go into mid caps because of superior performance. So we'll of course select some of those also, small caps, because we have the leeway of 30-35% in other stocks also. Doesn't have to be small cap, but it could be small caps potentially. So stock picking is all about value addition, and we believe that we have added good value to our stock picks, and we remain a growth house, but with strong stock picking skills. But how much difference can stock picking make? So to look at the historical patterns, we looked at the 150 mid cap stocks that were present in 2020. So about 5 years ago, whatever the mid caps were, 150, we looked at their performance and tried to see what the situation is today for them. So out of those 150 stocks, 24 actually became large caps today with a return of 6.7x average, CAGR of 58%. 82 of those stocks remain mid caps with a CAGR of 26%, 2.5x. 41 became small caps. They went down with a CAGR of 0% on an average. But those 41 were replaced almost like to like by 43 small caps, which became large caps. Average return of 7.3x, which is almost 60% compounded. So, huge difference can be there, 2.5x versus 7x, that kind of a return when you pick stocks, right? And we'll try to make sure that we follow our original philosophy of terminal value investing, growth investing. And that's how we can add value by picking from the mid and small cap universe. Maybe some sprinkling of large cap, but mostly towards the mid and small cap space. So that's our core competence of stock picking, and that's how we aim to do that. So I think that's it from our side. Happy to take any questions about the fund or the markets, etc. But again, thank you so much for your existing support. We started from zero. Less than 2 years ago, we started from zero equity base, and today we have 2,800 crores in equity funds across 3 funds. This is the 4th fund we are launching. It's all because of support from your community. Thank you so much, and look forward to your support in the existing funds as well as in the new NFO. Thank you.
We will now open the floor for the Q&A session. Please feel free to share your questions. Sir, we have first question from the Amitesh Kishore. Uh, Dear sir, we have recently seen many PPT explaining that mid-cap valuation have been quite stretched right now, even after a year and a half of almost no returns. What do you see as value in the launching this NFO right now?
I think I answered the question.
Yeah.
First, I saw as you can see, the P ratio has come down from almost 36 to 27, which is closer to the longer term average. And the good part is that this is happening at a time when the earnings growth is picking up. And as I just mentioned, the earnings growth expectations for the mid cap universe is close to 20% for the next 2 years, much higher than the large cap. So if you look at growth adjusted valuations, say for example, the P to G ratio, growth ratio, P to price to earnings to growth ratio, it's actually quite favorable for mid caps and small caps. So I think that the fact that maybe I should show the screen again. Yeah, these are the valuations for the last 7 years. So we are now a little above average, not too much above average, I would say, and it is coming with good growth expectations. So I don't think we are in that overvaluation phase anymore. There is ample scope for stock picking now.
Sir, the next question is why NFO currently? I think you have already answered this. What's valuation of mid cap index? What is the premium to last 5 year average after COVID? If you want to add something, so.
So as I said, we are not trading too much higher above the average, right? So the last 5 year average would be around 27, 26, 27, 28, and we are trading at around those levels. So we're not that expensive anymore.
There is a question. What's your view for short term and for 2 to 3 years?
Right. So now I believe that the markets will give you returns in line with earnings growth because that overvaluation is gone. And earnings growth, as I said, for the large cap index seems to be about 12%. For the mid and small cap index is something around 20% that we just saw, right? So those are the kind of returns. So let's say small cap, the large caps will give you 10 to 13% returns, and the mid and small cap indices should give you somewhere between 15 and 20% growth.
Sir, your view on lump sum or SIP?
Um, I would always go for a mix of lump sum and SIP. So maybe some lump sum and then go for a STP or something like that. Because there are still moving parts. Mostly the risks, as I said, are global in nature. India, mein to, whatever we had to do internally, we have done. So I don't think we have too much to do in terms of internally. But given Trump does something, there might be Iran war, those kind of events keep happening. So it's always better to, stagger it out. So maybe partly lump sum and partly you can go for a STP kind of a thing.
So the next question is when is earning likely to go 12 to 15?
I think I answered that question. For the large caps, we are not expecting too much more because they are mature companies. I think the higher growth will be in the mid and small caps.
Sir, the next question is any sector specific approach which looks more value for money?
Sure. So broadly speaking, there are few themes that we like, which again we have seen that if you look at our past track record and past portfolios, some of the themes that we like basically fall into these broad baskets. I'll just share my screen. So these are some of the themes that we consistently like. Uh, as of now, I think all the premium consumer discretionary premium items in auto ancillaries, for example, premium services like hotel, travel and tourism, airlines, gems and jewelry products, may high-end bikes, high-end cars, liquor consumption, those kind of names you will see in our portfolio because we believe that these segments which are premium in nature will grow faster as income levels are going up. Second is everything to do with capital markets and savings should do better because income levels are increasing and so are savings net. We also believe that at this point in time, even banks and NBFCs look good because valuations have corrected to good levels. Then we have this whole theme of physical asset creation in terms of capital goods, machinery, construction, railways, defense, infrastructure, renewables, real estate, those things we like because unless those grow, we will not grow at 7-8%. So that and government is also very focused on that. It includes sub-segments like chemicals, pharmaceuticals, auto ancillaries, as I mentioned, because they are also part of the physical asset creation. So we like those themes. And third is selectively we like stocks where technology is being used to create new business models. So those are some of the themes that we like. In terms of our portfolio, we are overweight on financials. We are overweight on consumer discretionary. We are overweight on some of these, new age stocks, very selectively though. And we are underweight on IT, FMCG, utilities, energy, oil and gas, metals, to that extent. You're on mute.
Sorry. Your views on US debt and rupee dollar.
Rupee dollar, I think, should stabilize now. Uh, Last year was the exception, I would say, because there was a lot of FII selling that hurt the rupee, I think, more than anything else. Going forward, I think dollar is structurally going to be a weak currency. So versus the dollar, we should be stable.
Sir, IT sector when to invest?
Good question. I think there's still a lot of moving parts. Let's wait for some time and see how the dust settles.
Another question is, sir, your views on IT sector and realty sector.
IT, I just told you. Real estate, I'm positive in the long term. There might be a short-term slowdown that we are seeing in certain pockets like Delhi, Bangalore, etc. But if stocks really get smashed, it's a good sector to be in.
Sir, the next question is, given the data in slide 9, 13, and 18, for the growth potential of mid cap in comparison to large cap and small cap, the growth should be considerably high in comparison to small cap, not just by some percentage, especially after 15 years in slide 19.
Yeah, thing is that you need to pick the stocks right? Because in mid caps you have 150 stocks to choose from. In small caps you have maybe 800 stocks to choose from. So in the case of small caps, really the aggregate does not make too much sense. There's too many stocks in the basket. So we just have to selectively choose the ones which have the highest growth or higher growth expectations compared to the others. So I think the universe is very large.
So the next question is, can you please explain in simple term about terminal value, vice versa, intrinsic value?
Intrinsic value.
Sorry.
So yeah, so intrinsic value basically is essentially more linked to, I would say, the assets of the company, the physical part of it. Terminal value is about the longer term value of, sorry, terminal value is more about the value of the really long term profits, not just the short term profits. So the present value of the back-ended profits which are expected to be there after 7, 8, 10, 12, 15, 20 years, the present value of those is called the terminal value.
If remains gold.
Sorry, come again.
If dollar remains weak, then your view on gold.
So my view on gold has been positive, and exactly for the reason that the person has mentioned. Weak dollar means a flight to say other assets, and I think the way the world is going, the money printing game is still on, and as long as there is money printing, dollar will remain weak, and gold should do well.
Dear participants,
But it's a long term view. Huh? Don't speculate and don't leverage. It's an investment view, not trading view. Stick to your asset allocation.
if you have any further question, please drop a message in the chat box. Sir, we have answered all the questions. Do you want me to
Great.
wind up the call?
Sorry. Great. Anything else, Rani?
Uh, no, sir, that's all. I have covered all the questions.
Great. So thank you again so much for your time and understanding and for your existing support. and look forward to a great success in this NFO. Thank you so much.
Thank you, Mihir sir. Thank you, participant. We look forward to your continued support and thank you so much once again. Have a pleasant evening.